And you might be thinking, well, why are you showing this with all these negative charts that you just showed? But again, remember, it takes a while for the economy to turn. Hi everyone, this is Rob Roy and welcome to this edition of the Elliott Wave Options US Market Update. Before I get into the update, just wanted to send some thoughts and prayers out to the people of the Bahamas. I live in the east coast of Florida, so it's been a trying couple of days here, but with the storm just sitting there churning on those poor people in the Bahamas, the videos I'm sure you've seen are just horrific, and there's a loss of life, and I'm sure the damages are going to be unbelievably catastrophic. So again, thoughts and prayers out to those in the Bahamas, and as well as my fellow Floridians, and see what happens over the next couple of days as the storm moves, and everybody up the east coast that could receive a landfall. This is part of living in paradise. We have to deal with these hurricanes, but this one's done enough damage. It needs to just go out into the sea. We'll leave it at that. All right, the subject of this presentation is going to be revisiting this subject that we've been talking about quite often, which is the pending recession based on the yield curve. Now, there's no guarantee that there's going to be a recession, although most of the indicators say they are, and I've prepared some charts for you to take a look at and to discuss, and we'll see. You can make your own determination, but the thing that bothers me is when you hear all of the pundits on TV making excuses saying, oh, well, it's because of the countries with negative rates and all, it's pushing things down, and it's different this time. And we've talked about this in past recordings, but when you hear that phrase, it's different this time, it's usually not different this time. It's usually the same thing. It's just people try to find excuses not to scare people. Remember that those on the financial networks, most of those people are money managers. They have assets under management, and they want people to keep their money there because they get paid for having assets under management. So they want people to keep their money in. They don't want them to get worried and take money out. So they find all these excuses for why people need to stay invested. So let's take a look at the charts and give you a little bit of commentary on what I'm talking about. The first chart that I wanted to show you is interest over time. This is the viewpoint, if you will, of those thinking that we're going to have a recession or we're not. And you can see that the indicator has gone all the way up to 100% just recently. So is it different this time? I don't know. It doesn't appear to be. But the important thing to remember is when you see the indicators that are flashing signs for a recession, it doesn't mean the recession's starting tomorrow or next month. It means that it's about 18 months down the road. A lot can happen between now and then. So again, it doesn't mean that things are going to get dire in the short term. It's a longer term indicator. So that obviously doesn't bode too well. Here we have a dynamic yield curve. If you watch it, you can see as it moves, and the dates in the upper left-hand corner, you can watch that, and then you can see the years down at the bottom. And the key to watch is the 2-year right here, and then the 10-year. So look where the dot is above where it says 2-year, and the dot where it is above the 10. When the yield curve inverts, that's when you can earn more interest for holding something for 2 years, a bond or treasury for 2 years versus 10. It doesn't make any sense, right? You're supposed to get paid more for committing longer. So if you buy a 10-year bond, you're supposed to earn a higher interest because you're committing your money longer. So when you can earn more for buying a 2-year bond instead of a 10, doesn't make a lot of sense. So that's the inversion of the yield curve, and that's the signal that tells you, hey, something's amiss here, and usually it's a recession coming about 1.5 years down the road. Now you can see that it dips down to about 1.5% there on the 10-year recently, and I heard a pundit on Friday saying that I can't understand why anyone would want to buy our 10 years at 1.5% interest. And my first thought was, what? After I picked myself up off the ground from laughing, I mean, how about all those other countries that have negative interest rates? Don't you think that buying something at a positive percentage and a half interest might be more attractive than committing money? I mean, when you buy something at a negative rate, that means you're paying them to hold it. That means you're so worried about things in the future that you're willing to lock in a small loss rather than risk a big loss. Again, something that doesn't really make a whole lot of sense, but that's how it works. So bringing money over here where you could get a positive return at least, yeah, I think that makes sense to a lot of people. So I didn't understand that comment at all. So the next chart, PMI, Purchasing Managers Index, you can see that is moving to the downside, and that's never a good thing when manufacturing is declining. So you can see that's chopping down lower and peaked out towards the end of 2018, which is about where the market did and about where the economy did, et cetera. So that makes a lot of sense as far as what's happening with the economy and the forecast for a recession. We don't want to see that, but these are facts. This is what's going on economically behind the scenes. We keep talking about our economy being good, and our economy is good in the U.S. compared to a lot of places around the world, maybe every place around the world. We may have the best economy in the world, but that doesn't mean it's as good as it was recently. So is it the global economies that are dragging our economy down? Maybe, very likely. But it's just that we have to keep an eye on things and not just start resting on our laurels that, oh, we have a great economy. Well, we have low employment, but we need to keep things going, to keep the wheels turning and keep the economy growing faster than where it is. I'll show you the GDP chart in a second. But freight shipment, that one's, I think, kind of neutral. I don't really, not too concerned about that. It peaked back in April of 2018, but after dropping into December, it actually rebounded a bit. So I don't think this one is too bad, and that has a lot to do with consumers too, right? Buying stuff in addition to big companies. So it's not just tied to big companies buying stuff, it's the consumer as well. But this is the one that's the most concerning to me. I mean, the yield curve is obviously concerning because of its history of predicting recessions, but the S&P 500 earnings estimates coming down, it's hard to see the market go up when earnings are going to the downside. And that's what a lot of people have been focusing on, is this drop in the average earnings per share for the S&P 500. So when you see that starting to come down, how are stock prices going to go up when earnings are going to go down? If it is going up, it seems like it would be short-lived, doesn't it? So big red flag there. I think that might be the largest red flag of all. All right, so I just wanted to share those charts with you and show you that there are other things other than just rates that were flashing some warning signals. Now let's take a minute now and take a look at the S&P 500 chart. Okay, here's a chart of the S&P 500, and as you can see right here, we have been in a trading range. And it's a fairly well-defined trading range with the highs and the lows. The interesting thing is the volatility within the trading range. Usually when you're going sideways like this, it's a little calmer. When you're consolidating, it tends to be at least towards the recent part, a little smaller as far as intraday volatility, not these big, huge daily bars that we have here. But the other thing that's important we've talked about is this move to the downside here from that wave 5 high needs to hold these lows, the lows of the consolidation range that we're in right now, because it's right at the 61.8% level. So if we're hoping for a continued move back to the upside, we need this to hold. And if we have this area here where we've come down to a 61.8, what we could have here is a complex wave 5 with a zigzag setting up here. So that would be the A wave, and then the B right down here to the 61.8% correction. So then we use the fib extension tool, and when you use the fib extension tool, it gives us a potential move on the SPY up to about 313, which would be the wave 5, or excuse me, the C wave extension of the wave 5. So that would be our zigzag pattern. So we have a A, we'll label it A, B, and C. And you might be thinking, well, why are you showing this with all these negative charts that you just showed? But again, remember, it takes a while for the economy to turn. It takes a while for the economy to turn to the upside. It takes a while for things to turn to the downside. So could we have one more run in the market if the Fed cuts rates, if they cut the 75 basis points that the Fed Fund Futures says they're going to? Possibly they go back into quantitative easing, because they went through the tightening for a while where they were cleaning off their balance sheet, and they were actually withdrawing liquidity at an alarming rate. $50 billion a month was coming out. That's a lot of money from the market that was being taken out. So if they start quantitative easing and adding liquidity back into the market and cutting rates, that could be enough to give the markets one more run before things start to maybe correct a little more significantly down the road. Or that's the positive scenario, but the negative scenario that we've talked about is that doesn't hold. The 61.8% fib retracement doesn't hold. We come down here to 78.6, which means that potential zigzag pattern to the upside is negated. No chance of that happening. It becomes disqualified, and we're going to come down here to test that previous 4, because this whole wave 5 impulse would be retraced. So we'd be back down here. And then if we broke that, it could be Katie bar the door to the downside, because see, there is nothing in the way now that could add any sort of support. We just had that vertical move to the upside there. And when you go straight up, sometimes you come straight back down. So there's just not a lot of support for a break of this area where the wave 4 is. So we're kind of in between, and it makes sense with the market consolidating sideways, but it's going to be interesting to see. We may get a pretty good indication at the beginning of the week. We're coming off a holiday weekend. Friday doesn't really matter. Friday in August before a holiday weekend, there was nobody there. I mean, Fridays are already low volume as it is, but when you have a Friday before holiday weekend, the traders are gone. They're not there. But now we're coming and we're after Labor Day. It's kind of the official end of summer. Most of the vacations are done. Most of the kids are back in school. This is when the traders come back, and that's why sometimes September is not a very good month, because everybody comes back, and if you had a drift to the upside during the summertime, the low volatility summer, if you had a drift higher, then they come in and sell. We're kind of in between, so that we haven't really necessarily had that scenario where it would be one of those bad Septembers, but you have to look at the historical ramifications of September, and it's not been a historically positive month for the market. So it's going to be interesting to see. I wanted to show you on the VIX, we actually have a triangle forming on the VIX, which I think is quite interesting here. Very nice symmetrical triangle forming here. And you know what that means. We're going to get a breakout. Which way is it going to be? To the upside or the downside? And certainly, if the VIX breaks higher, that means the market's going lower, and that's not what you want if you're long the market. So see how that plays out. And then we've already done interest rates, but I just thought I would show you TBT real quick. We're kind of hanging around here on this wave 3 low, right there at that fib extension. And this 4 doesn't mean that the wave 4 is starting. It just means that if the wave 4 starts, that's where we're going. And that's one of the really cool things about this profit source Elliott Wave software, is the fact that it gives you potentials so that you can be dynamic with the market. And I think that works out really well. So again, it's not saying the 4 is starting, it's saying if the 4 starts. In other words, if rates start going back up, which temporarily would be a good thing. And that would be a positive for the market, because it's the lower rates that has been scaring everybody, because the rates have been coming down without the Federal Reserve cutting rates, right? So that when that occurs, that's an indication of a weakening economy. So I've been long-winded in this edition, but hopefully you've got some more information and things to look for. It's going to be a very interesting week. I look forward to our conversation next week to see how this week plays out with the volume returning to the market. So again, all of those that could be in harm's way from the hurricane, our thoughts and prayers out to you. If you like this stuff, don't forget, give us a like, hit the subscribe button on the YouTube recording, and we appreciate your attention very much. Take care, everybody.